Monday, June 7th, 2021, Monaco 64, home of alternative economics and contrarian views. So today we're going to look at how gold, silver, and the miners would do in the case of a major stock market crash or major correction. That's a question I always get from my viewers. They're always concerned about what would happen to gold and silver and the miners, of course. Before I start, though, I'd like to thank all of you for your support, for subscribing to the channel, for having an interest in what I have to say. Yesterday, we reached 50,000 subscribers, so thank you very much. So for those of you who haven't subscribed yet and enjoy my videos, please think about subscribing. Think about hitting that little notification bell to be notified of all my new videos. I make them every day. Sometimes I even make two. So let's go back to the past. That's always the best thing to do. This is not financial advice, of course. This is just trying to look at things and see what could happen. This is just my opinion. And later on, I will tell you how I personally am thinking and what I'm thinking of doing at the moment. There is, of course, always a lot of talk of the stock market maybe crashing, and the fact that we are near all-time highs is always a worry. So we've looked here, and we're going to look at the Dow going back to like '08. We're going to look at the CRB index, and we're going to look at the HUY to see what those markets did, so we can have an idea what could happen, let's say, if we have a crash soon in the stock market. So as you can see here, the Dow actually topped sometime in September, October 2007. Let's have a look here. It's look at this chart. It's getting difficult to look at it because okay, yeah, I think it was October 2007 the Dow topped, and it bottomed in I think it was March of 2009. So it took about, how long was that? About 18 months or so, maybe a little less, for the stock market to crash. If we look back at last year, stock market topped in February, and then it bottomed in the middle of March. So it took just over a month or so for the stock market to crash there. It was a very sharp and short crash. And why was that? Well, because I think the central bankers and authorities reacted a lot quicker. Back in '07 to '09, the authorities were not used to this kind of stuff. So it took a while longer for them to react. Am I saying that's a good thing? No, I'm just saying what happened. So I think if we do have a big crash, let's say 20 or 30% in the near future, we could see the authorities react even quicker. So yes, you might want to be load off a little bit on your stocks and have some cash. But you're going to have to be very nimble. You're going to have to be able to call your broker or hope that the trading system, online trading system that you use is up and running in the case of a major crash. Let's say it could be over a few days or a week, seeing that the periods of crashes are getting shorter and shorter. So it could be very disruptive. So yeah, you might unwind some of your stock holdings right now and have 10% or 20% in cash. And you could be right, the stock market crashes, but you might not be able to load up on stocks. And am I certain that the authorities, central banks and governments or treasuries would come in to save the system again? Most probably, because that's what they've always tried to do. Whether it works or not, I don't know. So that's the stock market there. So now let's look at the CRB. CRB, of course, is a measure, an index that measures all the major commodities, gold and silver included. And as you can see here, the CRB actually kept going up all the way to June 2008. So despite the fact that the stock market started crashing September, October 2007, the CRB actually continued to go up and only topped in June, end of June 2008. So it doesn't necessarily mean that commodities are going to crash now as well. They could crash, but it could be later. They could keep going up. Look at how the CRB kept going up. I mean, from 2007, I think when there was the initial crash, the CRB was around 370, and it still went almost up to 470. So there could be room for the commodities still. And that commodities crash, of course, happened from June 2008, and then it bottomed quite quickly. I would say, well, relatively quickly. It took 8 months for it to bottom in February 2009. And last year, CRB topped, and it wasn't really doing that well towards the beginning of the year, 2020, and it bottomed. Let's have a look. Around April, so it took about 4 months. So it's getting shorter and shorter because, as I said, the authorities come out and throw everything at it. So yeah, right now CRB looks overvalued on a medium to short term basis, but longer term, as you can see, there's still a lot of room on the upside. Let's say the stock market crashes soon, we could see the CRB dip a little bit, but then continue going higher like it did in 07 and 08. Who knows? So now let's look at the HUY, which is the Gold Bugs Index. It's an index of the major gold miners. And let's see what we did. Well, as you can see here, it topped in March of 2008. So it wasn't in September or October of 07. So it kept going up. And then it did crash during the Lehman crisis or the Lehman collapse, and it bottomed in October actually, so of 2008. So it bottomed before stocks bottom, and it was a very quick and sharp correction there, as you can see, from March to October, so about 7 months, and then it made a new high actually in 2011. So they don't really correspond exactly with the general stock market. What about last year? Yeah, last year, as you can see here, HUY dropped very sharply as well. But it was a very quick and sharp drop towards the middle of March. And then it picked up right away, right back. So I'm glad I did this exercise. So as you can see, they are kind of related, but they don't trade in tandem with the general stock market, and that is for commodities and miners. And I'm glad I looked at it because I do have miners. Yes, my holdings would get hurt if there was a stock market crash and a sharp, quick correction like this. But I am wondering whether it's worth it to have fiat cash on the side to add on during a crash, and to do that I'd have to actually liquidate some of my miners. So I think personally I'm gonna hold on to it. Prior to looking at these charts, I was thinking maybe I need to unwind 20 or 25%, and you might want to do that, but I don't think I will. As for gold and silver, we all know what it did last year. In 08, I know what it did because I was already around. I'm an old guy. I was actually working in the city. I was sitting at my desk watching everything implode. Gold had actually gone to a new all-time high in March of 08, just above 1,030, and it topped there. That was the day that Bear Stearns had to be salvaged. And from that level up until the Lehman collapse, gold dropped from 1,000 to around 680. So a drop of over 30%. But I can tell you that summer and early fall, it was really hard to get physical gold and silver as well. The premiums were even worse than they are now for gold, for silver as well. And it was really hard to get the physical stuff. If you're trading paper gold and silver, that's a different story. But the real thing, yeah, you should consider gold and silver as cash. They are the original cash, really, because that's what cash is. Cash is what you can redeem a promissory note into. It's also called specie. The cash that we talk about today is not real cash, the fiat cash. It's a wrong term to use. So, yeah, I would hold on to gold and silver as well, because it's going to be very hard to get any. And we need to also think about what happens if there is a crash. And even if the authorities intervene, what if it doesn't work and we have major bankruptcies? Well, you want to have no counterparty risk, and that's why I'm going to hold on to my physical cash, to my specie. By that I mean, of course, silver and gold. So, yeah, and I think the corrections, as I said, or the pullbacks in commodities and even the stock market, in the HUY, they're getting shorter and shorter. So I would say if there is a slight correction in the paper price of gold and silver in a stock market crash, it will be very short-lived, just like the stock market crash could be very short-lived. It could be over a week or two this time instead of around a month or so we had last year. And of course, a lot shorter than it was from 07 to 09. So, yeah, hopefully that helps you. As I said, I'm not here to tell you exactly what to do. The reason for my channel is not that. It's just to give you an idea how I think and how that might help you. You might want to do something completely different. But yeah, and you should, if that's how you feel comfortable about things. So with that, let's quickly look at where the markets are this morning. It's 7:25 a.m. London time. We've got spot gold at 1882.70. It's down about 8. Yes, we're going to see a bit of volatility here. We saw a lot of it back in the back end of last week, so I'm not surprised. The high's been 1893, the low 1882.30, so we're right near the lows here. A spot silver is down 28 cents or 1% at 27.50, right near the lows as well. The high's been 27.83, so the range has been relatively narrow, I would say. The Dow futures down 38, the NASDAQ futures down 32, and the S&P future is down 8 points. To the currencies now, sterling is down a 0.25% at 141.18. The euro is down 0.1% at 121.50. The dollar is unchanged versus the Japanese yen at 109.50. And the dollar is up slightly versus the yuan, just below 640 at 639.68. The Aussie dollar is at 77.33, down about 0.1%. And what would the Aussie dollar probably do in a stock market crash? It would end a commodities pullback. It would probably go down a bit versus the dollar. But the Aussie dollar looks pretty stable right now, around 77. Yeah, it's not really doing much. To the commodities, we've got WTI crude down 0.2% at 69 exactly. We've got high-grade copper down 1% at 448.72. And the 10-year yield now, to finish off, the 10-year note yield is up about 2 basis points at 158. Still pretty steady. I think personally they've killed the barometer of the bond market. And what do I mean by that? Well, the 10-year yield is not real. It's been manipulated, and that's why it's dangerous to investors. It's difficult to see really what's under the surface, and that's why, yes, we could have something like a stock market crash. And what do I think people will consider the trigger for it? Well, it could be what the Chinese did recently by raising their reserve requirement ratio. You know, that means draining liquidity from the system. It could be because of that. Who knows? So if you enjoyed this video, please make sure you hit the like button. Think about sharing it far and wide as well. And as I said earlier, think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Facebook, Twitter, and all these other platforms below here. So I wish you all a great day. Take care. Bye.